Hello, what's up, guys? Welcome back to Zodiac Trading. Today, we're going to talk about China's incoming systemic risk is about to unfold. And there are many things and many signs that investors should be looking at because this time is going to be a shitstorm. It's going to be huge. And I don't think Chinese policy of these extend and pretend strategy would would be working anymore. So there are some very interesting facts and some of views that I think you guys deserve to know about. Okay, so basically, the entire Wall Street and the U.S. has been, quite complacent with the fact that China has been having these rapid growing economic GDP growth for, nearly 20 years. And as a consequently, the developed countries enjoy these very low cost products and also enjoy these very low uh, and very high cost efficient of global economy model. But now with the intention rise between China and US, these globalization model gradually fall apart. So now it is crucial and very important for international investors to recognize the fact that China would no longer, very likely, China is not going to have a normal relationship with U.S. and most likely, this situation is going to be much worse as the time passed because of the Taiwan and the Japan kind of issue and the problem between China and India. With that tension rises, the U.S. the conflict between U.S. and China would only go one way, which means China would be against by most of the West nations because of its intention to expand. Then uh, that's going to bring the situation much worse. And as a matter of fact, that is going to hurt Chinese GDP growth as well. So there are several things that I believe will cause China having the systemic financial meltdown and risk. First would be China's huge debt question. Okay, the huge China's debt problem. When we're talking about Chinese debt problem, we are talking about LGFV. We're talking about local government financing vehicles. In Chinese, we call this 城投债, and it's very like the municipal bonds, but it work completely different in a completely different manner. So LGFV is a very important financial instrument. It's serving like municipal bonds, and it helps the local governments to operate and to help it financing its physical resources. So LGFV right now is facing huge problem because uh, right now China has nearly $140 billion worth of LGFT debt problem, and couple months ago, it started from Guizhou. Okay, so it started from Guizhou because the Guizhou government is not capable of paying back the interest of these municipal bonds. So what the Chinese government can do is to swap that kind of debt and to replace that debt with local bonds, and hopefully that bonds could continue, and with the financing of the central bank, these trick and mechanism, these simple trick can go on and on. But the problem, as a matter of fact, with the deteriorating of the Chinese fiscal situation, I don't think the LGFV problem can be contained for longer. So because LGFV is very important, it plays a key role in infrastructure project. It is the major growth driver of the Chinese economy. But these LGFV, they are operating in a very in in sort of black box because it's not transparent. It's very difficult for external investors to actually know what's happening inside of these vehicles because the LGFVs, these products are being packaged as like wealth management product, and lots of the wealth management products are sold to many wealthy individuals across China. And they will be most of the time they package as these financial products with stable interest, and the investors, the wealthy people who are buying these LGFVs without knowing the real risk inside will just continue to buy. So they're kind of trading like a fixed income. They want to buy LGFV for, let's say, 6% or 7% of nice return, and then the people who are in the middle selling these products, the intermediary who's selling these products, these agents who are selling these products would probably make 2%, and the government would make like 5-6%, like maximum 5% out of it, and there will be a lot of intermediary inside of these LGFV trades. So it's not like if you're in the United States, if someone is interested of buying the municipal bonds, they have these transparent, they have these auction, so you can actually see the bid and ask. You see how the price go, but it goes completely different within this LGFV market because you don't see the bid and ask. You do not see there is actually an auction process. There is no auction process exist if you want to buy a product like LGFV. So you just get all these high tier sort of agents who claim they have very good relationship with the local governments and they can sell this product with a little bit of markup. They will put a premium out of it, so they are making money out of it. So LGFV, it's a very I would say very shady kind of investment vehicle to rely on. So if any investors have good experience staying in China, they know what exactly I was talking about because everything in Western financial market, I wouldn't say everything, but most of the thing in the financial market in US or in Western financial market is transparent. You can actually, the investors has to disclose a lot of information in the public market. But in China, it doesn't work in that way. In the most scenarios, the external investors, the Western investors, they are told with the nice and sweet lies that they like to hear, but the fund managers have no problem to it because they get fat commissions convincing their investors, the Western investors, that China is a rapid growing economy system, and they could get really big and fat commissions out of it. And this scheme has been, keep going for a long, long time, and now it finally comes to an end because the local bank because the local government, you have to understand that China's tax system. The Chinese local governments, they don't get their financial resources by taxing. So that means they are raising money through these LGFVs, and they are actually selling a lot of lands. If they sell lands, they get income, or the central bank will give them some additional funding. But the most source of local government's operation rely on selling lands. So if the Chinese housing market explode, everything goes down with it. So the government has no money or no cash to get money from selling lands. So the government's going to have a big problem paying back the interest of these LGFV products. So that kind of panic would just go on and spread, even though Chinese government trying to swap or trying to restructure the debt, but that is not going to happen because as you can see, with allow local government to issue bonds and interest rate around 3% to replace expensive LGFT debt. Some cities pay 7 to 10% in interest rate. The reason why LGFV is expensive is because of these middlemen or of these agents. Um, they are hiding in all of these LGFV trades. Maybe these products is originally 3%, but with these, everyone is trying to take a commission out of these LGFV products. So that's why, agent A makes 1%, agent B makes, another 0.5%, and another agent C makes like 1.5%. And all three of the agents, they claim they have very solid connection with the governments and they are highly corrupted. That's why you, as an investor, you end up paying, like getting paid like 7 to 10% of interest. And that will be the government's burden because the government should be paying these 7 to 10% of interest, and it's almost impossible if to pay off if the local governments cannot sell lands. So that would be the first thing, the first reason why China is going to have a systemic liquidity crisis, a systemic risk, is because the default and the inevitable failure of LGFV market. And the second most important reason is that you have panicking. You have a lot of wealthy investors flying. They are having their capital fly away from China. They're trying to take as much money out of China as possible. If you want to know, if you actually want more of the indicators, you just look at the Hong Kong dollar rate. Okay, if you go to see how Hong Kong dollar versus Chinese yuan, you see right now Hong Kong dollar is trading at 0.92 when you compare to Chinese yuan. That means Hong Kong dollar right now has been rising. Okay, and in the same time, Chinese yuan has been depreciating very quickly because basically you have huge demands of people. People are demanding more Hong Kong dollar to convert to dollar instead of renminbi. So people are actually the wealthy people. They are expressing their very pessimistic views in Chinese economy system. So the way they accomplish that is through converting these currencies. They're trying to get as much as Hong Kong dollar as possible. So you ask a very important question: why are they going to get so much of the Hong Kong dollar? It's because that they want to get their money out of China. So they either don't want to get their money confiscated by the Communist Party, or they trying to get their money out of and invest in some other countries for better yields and better return. So actually, if you look at this chart and you actually look at the capital inflow of Singapore, and you know how serious the situation is, that is because apparently a lot of family offices are moving out from Hong Kong and put their capital in Singapore. So if you look at all these indicators, you understand right now the Chinese millionaires, billionaires, they are just panicking because what happened during the COVID-19 pandemic crisis and what happened with the policies. Right now, the Wall Street, is trying to feed another fancy story to the global investors. Now they are trying to convince the fact that China's PMI is now reviving, and Chinese government is bringing out a series of strong actions. They are going to bring out a lot of policy tools, but in fact, de facto, these policies won't work, and they are there won't be much policy power that they can rely on. So which I will be explaining later in this video. So as you can see from this chart, you see a lot of millionaires, they're leaving for other countries. Okay, so China has the most millionaires running out of China. Okay, so that brings, because of if you look at the foreign exchange rate of Chinese renminbi, and you look at what happened to the Hong Kong dollar, just happened a month ago, near August the 16th. We were witnessing one of the strongest Hong Kong dollar rate ever. We were seeing like nearly 0.94 Hong Kong dollar rate versus the Chinese yuan. So that would be a key signal telling you people are trying to run away, and people are trying to convert their assets to dollar based instead of renminbi based. Okay, so the third reason why I believe China right now is facing one of the biggest systemic risk, and most likely this is not going to end up like Japan. If it would be lucky to end up like Japan, to be honest. So in the worst case scenario, it would just becoming a much longer recession, because Chinese financial market right now has a very bad reputation, and right now has very bad transparency, and I don't think it would attract more investors, smart investors, to keep investing in China for any longer. So the third reason is that I believe there is a re-globalization going on. So that means a lot of industries are leaving China, a lot of investments. People, if you actually look at the foreign direct investments right now, it is shrinking. If you look at the foreign reserve right now, ever since the trade war happened in 2015, the foreign reserve of China plunged. Right now, most of the developed countries such as Brazil and Mexico actually has a much better foreign reserve prediction compared to Chinese foreign reserve. The key reason is because right now the authority wants to maintain strong control of its currency. So that's why the Chinese government, they just keep selling the U.S. bonds, but in the same time trying to use the dollar that's been sold by these bonds to buy back these renminbi, to fix these currency rate at a stronger level. So it is a gesture that what they want to show to the foreign investors, to show it to the Western society. Now we are very strong. We're still as strong as you used to, and please do not leave, and please do not stop investing us. And we are coming back. We have series of policy tools, but for a matter of fact, if you can actually read Chinese, and if you actually start building any social account, if you have any social account in China, maybe if you have a Douyin account, you have a Zhihu account, and you can read simplified Chinese, you understand what they are trying to do is the complete opposite of what they are saying. I don't think right now we have seen many very strong tools being released. What they're trying to do is they're trying to just keep doing their extended pretend strategy. They're trying to restructure their debt without telling the fact that they are restructuring. It's pretty much like the Evergrande issue, right? So you see a zombie real estate developer that never goes to bankrupt. But however, this company has huge debt, and without bankrupt, it's not going anywhere. But it just, these kind of companies just keep haunting you. They just keep haunting these foreign investors, because it seems like the story will never end, because nobody knows what will happen to Evergrande, and nobody knows how Evergrande is going to do to pay off its debt. So I think this is what happened now in China, in the financial market. Even though Ray Dalio, many fund managers said China, they have a great outlook for Chinese economy, but I strongly disagree with that because right now, Ray Dalio apparently he is such a big fan of China, and every time when he is asked of China, he will talk about some dynasty stuff, we talk about some history stuff. It's pretty much like he's kind of repeating what uh, the Chinese officials, the Chinese bureaucrat system were trying to say. The fact is, the fact is, he understands China is right now facing a deleveraging process, and most likely this deleveraging process is not going to end well. Okay, so it's going to end miserably, to be honest. So right now he has to change his tone. He has to change that. So right now he's no longer saying that China's story on China's good story or whatever. Right now Ray Dalio trying to say, oh, China needs a better deleveraging process. He needs to have a sort of beautiful deleveraging process. So this is the original title from Ray Dalio from LinkedIn. He says China needs to engineer a beautiful deleveraging, but where does this beautiful deleveraging come from? You can see from the foreign currency. You can look at the housing sector. You look at the PMI. You look at the inflation. If you look at its debt, if you look at its foreign reserve and exchange rate of its currency power, and from every aspect, China is going down, and that is a fact. Okay, and right now, China, what they're trying to do is trying to maximize its power in the social media and in every bit of the newspaper that they can reach. Every financial expert, economist that they're trying to bribe, that they're trying to convey you with a different story. They're trying to tell you the otherwise. Keep investing in China and never liquid. As long as you are not, withdrawing from the so-called Chinese economy flagship fund, you can make money forever. I mean, it's a fantasy. It's a fantasy just like the Bernie Madoff kind of fantasy. It's a Ponzi scheme, essentially speaking. So today, this video, we talked about why I believe China right now is facing great risk. So it's the time to go to sell everything. And I've said this is a huge debt problem, and China is not going out of it. And we are clearly seeing signs everywhere. So for clever investors, they need to know what to do. And most importantly, they need to take actions as quickly as possible. So again, thank you guys for watching. If you enjoy the content I'm uploading, please press that like button for me and share. That is very important because if more likes I get, the more views I get, and more people will know about this message. So thank you guys for supporting me. It's your support that helps me to keep updating new contents on daily basis. So I will see you in the next episode. Goodbye.